So right now, the average new car payment is $750 a month, and the average used car payment is at $550 a month. And this right here is exactly what negative equity looks like. 5% of all auto loan debt is over 90 days delinquent. And even though these delinquencies are at the highest rates that we've ever seen, well, this is just the tip of the iceberg. There is a lot of data that they're not telling you, and I'm going to share it with you in just a little bit. And we have companies like Carvana that are writing bad loans to make this problem even worse. And all of this hurts the car market because it leads to tighter lending and to higher borrowing costs. All right, so check out this Bronco right here. This is exactly the kind of thing that I'm talking about when we're talking about negative equity in the system and how it can be so bad. You can see the inventory situation right now that Ford is dealing with. So now what does that do to the value of the vehicle of that Bronco that customer bought last year? Well, now what they're dealing with is, since they paid so much over MSRP, that the value of that Bronco that they own now is about 50%, 50% of what they actually paid for their Bronco just about 12 months ago. And this can carry over, you think, Dodge Challengers, Chargers, all of these markups that these consumers were paying. It's the same story. And even on the Dodge side, it might even be worse because they're taking even more off than these Ford dealers are for those vehicles because they're having such a hard time selling them. It's just a massive, massive disaster for negative equity and for the consumers that own these vehicles that purchased them just 12 months ago. And here we go. We have Carvana, which is really the epitome of everything that's wrong in this car market right now, where we just had this report out from Hindenburg that has speculated that Carvana is writing a lot of bad loans, and they have actually went and interviewed some employees that used to work at Carvana talking about their loan acceptance rates. And what they said was it was right at 100%. And the qualifications for getting a loan through Carvana when they wanted to sell one of their vehicles, well, you had to be 18, you had to have no bankruptcies, which, I mean, what 18-year-old's going to have any bankruptcies? And they're going to, they have to make up to $5,100, not up to $5,100, they have to make $5,100 a year. And what they're doing is they are approving these types of customers for loans on vehicles that are $15,000, $20,000, $25,000. Of course, this stuff is going to destroy the car market when you have companies like Carvana that are writing these kind of loans and then trying to package them and sell them to another bank. And then, okay, that bank, which is Ally, is stepping back and saying, okay, well, our loan books are not looking very good, so we're going to have to pull back on our... Of course, you're going to have to pull back on your auto lending space when you're getting loans like this from a company like Carvana. So here's probably the biggest problem and why we're seeing more auto loan delinquencies right now than we've ever seen before. Because on really face value, the economy is not doing all that bad. People still have jobs and they're able to make money to be able to make their car payments. But why are there so many people defaulting right now when we're not going through an economic crisis? Well, the average new car payment is $750 and the average used car payment is $550. And when you combine that with everything inflation related that's going on with cars, you think car insurance, any kind of repairs that you're going to have on cars, well, people just don't have the money to be able to do it. And even though they're still working, they're still making money, groceries are more expensive. Just being able to rent a house is so much more expensive now. All these added expenses, it almost doesn't matter that the economy is doing okay if the amount that these consumers have to pay on a monthly basis for their vehicles, they just can't do it. So what's happening? Something's got to drop, and what's dropping right now are auto loan payments. A lot of people have cut that out and they're not making their payments and they're going delinquent on all of their vehicles. Now, there are ways that banks and dealers can actually combat this repo cycle that we're going through right now. As repo rates increase, well, these dealers are going to know that, okay, there's a high likelihood that this car is not going to get paid for, so we have to figure out how we're going to be able to get our car back. So what they do, in a lot of cases, these small dealers that do buy here, pay here, what they'll do is they'll actually put GPSs in a lot of these cars when they're writing loans for them. So they know exactly where that car is at any given time. So whenever that consumer stops paying for that car, they can go directly to it and go pick it up. Another thing that they'll built into this, a lot of these GPSs, is they'll have automatic kill switches for these cars. So whenever a car is stopped at a location that they want to go pick it up from, they will actually be able to shut down the car, where even if you have the key, you can't start it, you can't move it, and that car will stay right there until they come with a tow truck to come pick that car up. Very ingenious thing for a lot of these dealers to put into their cars, especially when they know that repo rates are climbing and they don't want to risk losing that car to a customer that maybe knows that they don't want to make the payments on that car, and they know that the dealer's going to pick it up. And in some cases, that consumer will end up trying to hide that car so they can keep it and the dealer can't find it. And I can't believe that we're getting to this point in technology, but we've even had Ford that has filed a patent to have a car self-repo. And what does that mean? That means, well, we have all this autonomous driving right now, so Ford has this patent to have a car, when you don't make your payment, can actually drive itself back to either the dealer or the financial institution, so that car gets back and you don't even have to have a tow truck driver involved. Now, we are probably years away from this technology getting implemented, but just the simple fact that a manufacturer would try to protect this kind of technology, they know it's going to be a big thing, and they know that a lot of these banks are going to actually want this into their cars that they're loaning out, because it just makes it much safer for these banks to loan out cars. It seems very dangerous for the consumer when you get a lot of this autonomous driving in there, especially when, okay, you're coming out of the store and your car just starts driving away. I mean, what are you to think if that's the case? Yeah, you would know what's going on if a tow truck driver's in front of it, but just say nobody's in the driver's seat, the car just drives away. Well, I guess we didn't make our payment this month, so our robot car is just going to go turn itself in. And this is just the beginning of the problem, because you're having all these cars that Carvana is probably overcharging a lot of these consumers for, and then it's just adding to the negative equity situation. And this is why a lot of people are not paying their car loans. They're walking away from their car loans because they paid way too much for their cars. They got into loans that they shouldn't have. It's really on the customer to not get into that loan that they know they can't afford. But then you're supposed to have these banks that double check to make sure that these customers can actually afford to make these loans. And Carvana at this moment, from what Hindenburg is saying, is not doing this. And it's so bad that the bank that they're selling a lot of these package loans to is now having to step back from their auto book because their loans are so sketchy at the moment. So now, how is this going to affect the car market? How is this going to affect consumers just in general? Well, what happens is that banks, as they're taking more losses, as they're seeing that the environment's getting tougher on the consumer to actually make their payments, well, they end up tightening up. And what does that mean? That means that they limit the amount of people that they're actually going to loan money to. And that affects the whole car market, because how do we know that consumers buy cars? Well, they buy them on credit. Nobody pays cash for cars anymore. That just doesn't happen. Most car buyers right now are payment buyers, and in a lot of cases we preach so much about this, to where you don't want to be a payment buyer, but even more so if you are going to finance a car, you don't ever want to go into a dealership and say, well, I want my monthly payment to be this, because that opens yourself up to be gouged. But really, how does this all this affect the car market? Well, if you pull more consumers out of the market that were able to get loans, and now they can't because of the environment, leads banks to tighten up on a lot of these loans, then you're going to affect the actual sales from the new car level to the used car level, because you're just taking consumers out of the market. And whenever you do that, it's going to hurt not only the banks, but it hurts the dealers, it hurts the manufacturers, it hurts everyone around. And it really, if you don't have velocity of money that moves through the systems, then you can have something like, okay, new car dealers, what we're seeing right now, they're having a hard time selling new vehicles, so we're getting fewer trade-ins on the used car level. That leads used cars to stay stubbornly elevated, because we're just not getting money that's moving through the system. This whole system is built on credit, is built on debt. I hate to say that, but it absolutely is. And if you have that debt, that credit that is that's significantly lowered in the system, then it really hurts the car market just from the top down. And now you have these consumers that paid way too much for these cars a year and a half ago, and now they're defaulting on their loans. We're seeing this with all these spikes. And when they do that, what happens is it limits the availability of credit that they're going to have in the future. So not only does banks tightening right now limit how many consumers can actually buy vehicles, but the amount of repos that are going through the system, the amount of delinquencies that are going through the system is going to affect potential buyers later on, because now 3-4 years from now, when they want to go back and try to get a car loan, well, it's going to be very difficult for a lot of these consumers because they have a repo on their credit history. And when that happens, you go in to try to buy a new car, well, in most cases, you're probably not going to be able to do that if you have any kind of history of not paying your car payments. So they're going to be reduced to going to these wealth killers of these buy here, pay here dealers, where they're going to end up paying not at these new car dealers this 7-8% interest rate. Well, no, they're going to go to these buy here, pay here dealers and pay 25% interest. And this is what we're going to see in the market, and is what I'm very interested to see how it plays out. If we see a lot of these consumers that were more of prime borrowers are now getting kicked down a tier, and that just makes the car buying experience so much more expensive for a lot of these consumers at a time when monthly payments are already at their peak. Now you have credit challenged consumers that are coming in, and because they're credit challenged and because of the environment that we're in, it costs them way more money just to borrow the money on the money that they're already spending too much on the car. See what I did? We just more money. And that's going to just feed into more auto loan delinquencies. It's going to feed into more repos, and this is just a domino. And it's like a whirlwind of wealth destruction in the car market, just from people paying too much for cars that they can't afford, losing those cars, and then they try to go buy more cars that they can't afford. But now, since they defaulted a while back, well, then now they have to pay even more money for a car that they can't afford. See what it just keeps going. Yeah, terrible. So now you have banks across the car market that are pulling back on the amount of loans that they're providing to consumers for auto loans. And really the numbers say everything. That, okay, because the delinquency rates are at the highest that they've ever been, of course these banks are wanting to take the safe route and not write a lot of these loans that they know are potentially going to be bad. You have companies like CarMax in recent quarters have said that they were going to up their loan loss provisions, and what this is basically protection for losses that they're going to incur because of these loans that are going to go delinquent. What we're seeing at auctions right now, from my perspective, I'm a used car dealer, and I go to these used car dealer auctions, and what we're seeing is that maybe these loans that were written, I mean, we're seeing in real time that they weren't good, because the amount of repos that I'm seeing at these auctions continues every week to go up and up and up and up. And here's the thing, at a lot of these auctions that I go to, it's not just these big banks that are sending cars. It's not just big dealers. It's a lot of these small mom and pop buy here, pay here dealers. And what I mean by buy here, pay here are these dealers that you see on the side of the road that have $9.95 down on their windshield, and a customer can make $150 payments every week, every 2 weeks to be able to have a car. The problem is with those types of dealers is that they're not reporting anything, and these are the types of consumers that are defaulting the most right now, and these are numbers that we'll never see. There's no publicly traded company that's keeping up with this. This is not data that we're going to have. Bob's Used Cars on the side of the road, when they go and repo their car because their consumer missed 3 payments, they're not reporting that to anybody. They're either reselling that car on their lot, or they're taking it to auction to dump it because that car has been destroyed at this moment. So this, when I'm talking about tip of the iceberg, this is another element of it, that all the repos, all the defaults that we're seeing reported right now, it's not covering the subprime of the subprime of the subprime consumer. Those are the ones who are going to get hit the hardest in an environment like this, because those consumers, their credit's already shot, right? So they can't go and get a loan from Wells Fargo. They can't get a loan from Ford Credit, right? they're going to have to go to Bob's Used Cars, put down $1,000, and then start rolling monthly payments of $150. And then after they get their car repoed, well, it just goes right back into the system, and it's not, there's no data that's going to follow that particular car. That's in a lot of cases I talk about, well, you could be buying a repo and never know. So in my opinion, I think that this situation is way, way, way worse than all of these numbers will tell you right now, because we're just not seeing a lot of this data, and you'll never see it.